Investors don't get any better than Warren Buffett. A $1,000 investment in his startup would be worth over $30 million today. Such gains may seem impossible to achieve, but Buffett has proven otherwise. The reason is because he has figured out what the vast majority of people have missed and is refusing to budge from a set of universally applicable guidelines. And so, this is the Financial Bridge. Stay with us as we share Warren Buffett's 7 rules to keep in mind when it comes to investing. But before we get started, don't forget to give this video a like and a subscribe as well for more financing and personal investment content from us. We won't keep you waiting for too long now, so let's begin. When hiring new employees, we prioritize 3 qualities. We value brains, initiative, and honesty in potential employees. Without the latter, the former are useless. You don't want to end up with someone who's lazy and stupid because they lack integrity. The truth is that investors act in very human ways, which is to say that they get very excited during bull markets, which is exactly the opposite of what you want. They consider their financial situation from a year ago and predict, I made money last year. I'm going to make more money this year. Him or her this time around. These kinds of people have one eye on the past and one eye on the future. When they notice a lot of money has been earned in the past few years, they charge in and keep pushing the prices up. And when they go back and find no money has been made, they say this is a bad place to be, and they couldn't care less what's happening in the underlying industry, which is astonishing. However, that opens up a tremendous window of opportunity. Ben Graham has instilled a quantitative approach to purchasing. In order to invest wisely, we set out to find what we like to term cigar butts of stocks, which are similar to cigarette butts that one could find when strolling down the street. You glance down and see a wet, nasty cigar with only one puff left in it, but you pick it up anyhow and take a drag. It's disgusting, but it's cheap. Or rather free, because you just throw it out. After that, you start searching for another wet cigarette that you'll only smoke once. Although it's profitable, it is not sustainable on a large scale. Buying great companies has become so much simpler that we now prefer to pay a reasonable price for a great company rather than a mediocre one. But we hold the traditional view that we can and should rely only on our abilities to achieve financial success and success in endeavors over which we have some level of control. And we don't mean you have to have some sort of specialized knowledge of the product's function to consider that statement correct. If you want to succeed in business, you need to foresee how the company's finances will look in 10 or 20 years. As for us, we have a good idea of how the business case of Wrigley's chewing gum will read in 10 years. People's preferred method of gum consumption will not be affected by the proliferation of the internet. It won't make them switch brands of gum. If you corner the market on chewing gum and provide flavors like double mint, spearmint, and delicious fruit, your brands will likely still be around in 10 years. We won't be able to predict Wrigley's exact box score, but we also won't be terribly off. Looking ahead on a matter like that is within our area of expertise because we are familiar with the industry in which that company operates. What they do makes sense to me, both economically and from a competitive standpoint. But for Warren Buffett, the worst errors made were on his part. Of all the errors made, the ones he regrets the most are the ones he failed to commit. He lost Berkshire at least $5 billion, maybe much more. 20 or so years ago, Fannie Mae was experiencing some difficulties, and he was going to buy the entire firm for nearly nothing because of it. Also, he's not concerned with it. If it's Microsoft, it's because the company isn't widely used in the systems I'm familiar with, so he couldn't know what to expect. So he has no ground for presuming that he owed a profit from Microsoft, or cocoa beans, or anything else. And yet, despite his familiarity with Fannie Mae, he made a critical error that would never be revealed by traditional bookkeeping methods. However, he is aware of what this would set him back. It's no secret that he made a huge blunder by declining the offer. We are sure you're aware of that. If he didn't include them in a yearly report, you probably will. And there are times when he wants to give in. But he knows that unless he tells you about them in the yearly report, you won't find them listed under traditional county. So he tried his best to hold off. However, the greater sin is one of omission rather than commission. Big chances present themselves in life and must be taken. We don't do much, but when we have the opportunity to do something truly monumental and right, we jump at the chance. It would be a huge error even to do it on a modest basis. You can waste time waiting for the perfect moment. You only have one shot at life, and you need to seize every opportunity as it arises. After graduating from this institution, you should be given a 20 punch card and instructed to use one for each major financial decision you make. You become extremely wealthy as a result of your careful deliberation. If you only had 20 punches on your punch card and someone at a cocktail party told you about a company that he didn't know anything about or couldn't pronounce but made some money last week, you wouldn't buy it. Now, Warren Buffett has no intention of selling 100% owned enterprises. If someone offers him 3 times the amount he thinks something is worth, then he will definitely take it. He won't be peddling sweets, buffalo, headlines, or board polishes. It's possible that his perspective is incorrect. If he had 100% of Berkshire, he'd feel confident that his lifestyle choices wouldn't be wrong. He has more than enough money to last him a lifetime, so all he needs to do is to alter the wording of his obituary, reduce the amount of money the foundation has, and sever ties with the people he cares about, and who have joined him because they believe this is their forever home. Selling one of his children just because someone waves a big check at him is like giving up his right to raise and educate them because he'll be waiting a big check, and he needs to let his partners know he won't be doing it to prevent further disappointment. The strategy is now available for use with some stock investments. We might take a somewhat different strategy if we were constantly strapped for cash but had a flood of chances at our disposal. However, unless we feel extremely downtrodden, we have a little desire to engage in sales. Maybe there's a huge shift in the way things are run, or we just have a different idea about how the company's economics will develop. However, we will not be selling because it appears to be priced too high. Now, we know you have some questions in mind for Warren Buffett. This is first. How does he determine a company's true worth? Well, the answer to that is the intrinsic value of a company is the sum that would result if you had perfect foresight and could calculate the present value of all the cash the company would give you till the end of the time, using an appropriate discount rate. That's what businesses are really worth. Because, after all, the only purpose to invest and spend money now is to make more money afterwards, right? That is the essence of investing. At this point, consider the stock market and bonds. What this means is that if you buy a bond issued by the United States government, you can quickly and easily determine your expected return. The timing of interest and principal payments makes it simple to calculate a bond's value. You are the cash. The flows are printed on the bond. The analyst's job is to predict future cash flows, which could change tomorrow if interest rates do. It's time to put pen to paper and convert that stock certificate representing your ownership stake in the company into a bond. And in Warren Buffett's perspective, he is going to predict that it will pay out this in the long run. You all learn that when we invest in a new carpet making equipment for Shaw, we must consider not just the machine's cost, but also its expected return on investment. To be sure, the same holds true for a corporation of any size. The current price range for Coca-Cola stock is between $110 billion and $115 billion. You wouldn't be listening to me if you had $110 or $15 billion, but if you did, we'd be listening to you. But the real question is whether or not you are willing to part with your cash now in exchange for the benefits you will get from the Coca-Cola firm 2 or 3 centuries from now. As the future gets further away, the discount rate becomes increasingly irrelevant. How much money will they provide you? That is the question. That's not a question, as far as we or anyone else knows. As a whole, how many experts are going to endorse it? Or how much stock is now in circulation? What does the graph look like, if at all? The sole consideration is how much money you can make. It is true if you're planning on purchasing a farm. When you invest in a home, an apartment, a financial asset, or even oil in the ground, you are spending money. The next question is how much of your original investment you will get back in the form of cash later on. Exactly when can you expect it? So how confident are you exactly? And so, it's important to consider these factors when making business acquisitions, whether you are purchasing the entire company or just a portion of it, and in determining the inherent value of the business. Because of this, whenever we make a purchase, always imagine that you are actually purchasing the entire company. Evaluate the situation and tell the client what they may expect from the business and when, naturally, you want them to be able to invest their earnings for greater returns. As for Warren Buffett's Berkshire, they have never paid out dividends to its shareholders. But as the value of the companies he owns rises, so does their potential to do so. They have their own methods of internal compounding, but the main question is Berkshire selling for, let's say, $105 or so billion right now? If you want to buy the complete company for $105 billion, how much of that 100 can we give you? Now, can they get you enough money quickly to make it worthwhile at the current interest rates? Basically, it comes down to forking up the cash right this second. If you don't know the answer to that question, you shouldn't invest in the stock. If you or your neighbors feel like taking a chance, either of you can buy shares of the stock. Furthermore, to wrap this video up, remember the 7 investing rules. First, intelligence and integrity are the foundation. Second, pay attention to the facts, not emotions. Third, buy wonderful businesses, not cigar butts. Next is to buy only stocks that you understand. Fifth one is to always seize the opportunity. Our sixth one is don't sell because of price fluctuations. And lastly, buy stocks below what they are worth. We hope you like Warren Buffett's 7 rules of investing. And if you have something to share, then don't hesitate to comment your thoughts on the comment section below. Thank you so much for watching, and if you'd like to see more of the Financial Bridge, give us a like, subscribe, and click that bell button as well to stay updated for more of our latest and upcoming uploads. Thanks again, and we'll see you in our next video.